From New York City for our viewers worldwide, I'm Matt Miller. Markets are rising in the pre-market. The countdown to the open starts right now. We begin with the big issue, and that is the consumer slowdown.
I have, as the year progresses, inflation continuing to drift down into the mid-twos. That should be, along with the type of weakness that I think everyone is expecting in the form of labor market weakening, maybe some additional consumer weakening, that should give the Fed some breath to reduce interest rates. Now, obviously, the election complicates that, and any stickiness that we see, further stickiness in inflation that we see, is going to complicate that story. But I don't have a material weakening.
All right, we saw, of course, that PCE data on Friday, which showed a slowdown, a drop, actually, in real consumer spending. So after inflation, wages moderating as well, and we're going to have a busy week this week with economic data. So why not go to Michael McKee, Bloomberg International Economics and Policy Correspondent. He joins us for more. Before we get to, the granddaddy of all economic statistics coming out this Friday, let's talk about, Mike, last Friday. What happened?
Consumer spent a little bit less money, it looks like. Consumer spending came in a little weaker for the month of April. Remember, that's a delayed number, so we're about a month behind in terms of our ability to overall assess the economy. But the numbers we get from the banks who track credit card spending, et cetera, show that consumers have slowed down. And that's going to be the story of this week. Is the economy slowing down? We get manufacturing PMI coming up in just an hour. ISM manufacturing as well, and auto sales. That'll be a key indicator of where the consumer is. Have people started buying cars again, or are they still inhibited by high rates? JOLTS, everybody watches that to see if there's still a lot of job openings out there. ADP on Wednesday. That is the most famous indicator that people trade because they want to trade rather than they get a lot of information out of it. But services PMI is that day. And of course, we are watching to see what happens with service industry hiring, service industry business, and prices paid. And then we'll look at productivity and costs and jobless claims on Thursday, and then Friday. Wow. As you mentioned, the granddaddy of it all, and the payroll forecast at the moment is for an increase in jobs over last month, 190,000. That would be a sign that the economy is not cratering and not falling off a cliff. We'll see how that payroll forecast changes, Matt, over the rest of the week. Yeah, so, I mean, it doesn't have to be either booming or cratering, right? There's some middle ground sometimes, and we are looking for a gain in payrolls. I think you mentioned 190,000. The whisper number's for a little less, 185 right now, if you check out WHIS Go on your terminal. But the demand for employees isn't there like it was, post-pandemic, right? I mean, companies aren't hiring just in case. No, they're not hiring just in case, but they're not letting people go either, which makes JOLTS interesting, how many job openings remain out there. And, of course, the jobless claims numbers on Thursday. And then everybody's going to be watching the price indicators that are buried in these various numbers during the week. Manufacturing prices paid today, services coming up on Wednesday, unit labor costs on Thursday, and then in the jobs report, average hourly earnings. Is a shortage of workers still pushing up on earnings and making a case for inflation, or have we started to see all that come down to a more sustainable level? We'll check on with you on Friday on that. I noticed Augusta Saraiva wrote a great story on Sunday, yesterday, showing that, for example, consumer savings rates have come down to, she said, the lowest in 16 months. But I opened up the long-term chart and I see that we're back to, great financial crisis levels when it comes to the savings rate. In terms of consumer debt, we're at an all-time high, right? Over $17 trillion in debt. We've added $3.5 trillion roughly of debt since the end of the pandemic, and now at a higher rate. How much trouble is the consumer in as long as, she or he is still getting a job? as long as he or she is still getting a job, not too much, because people tend to spend what they make. The savings rate, while lower, has leveled off over the past couple of months. And the amount of consumer debt is always going to rise because the country keeps getting bigger and there are more Americans out there. What's important is the debt-to-income ratio that the Fed calculates, and so far, people are still below the levels during the great financial crisis, so it looks like they can pay their bills.
Debt to income. I'm writing that down. All right, Michael McKee, thank you very much. Bloomberg International Economics and Policy Correspondent. Joining us now with a look at the stocks moving ahead of the opening bells. We saw futures are rising right now, so what's driving that is Abigail Doolittle. Abby, what do you got?
Futures are rising, but just slightly, Matt. Beneath the surface, we have some massive movers, and not surprisingly, we have some of these meme stocks to talk about, including GameStop. The shares right now up 75, 73% off of the highs at one point, up more than a double. And this, of course, with Keith Gill and Roaring Kitty back announcing a $116 million position, plus calls. Now, it cannot be verified, but I did speak to Steve Sosnick over at Interactive Brokers, and he said that the calls in question, there is a large open interest, so it is certainly possible. And we have AMC going along for the ride. As for some other stocks that are trading higher, Stericycle, it is not a meme stock, but it is being taken over. The stock up 16%. The medical waste company is being taken over by the North America's largest waste company, Waste Management, acquiring it for $5.5 billion in an all-cash deal, or about $62 per share. The price pretty close, suggesting investors think it will get done. Summit Therapeutics up 12%. Lots of big gainers this morning. They raised $200 million in an institutional offering, and they are also expanding their license on a key drug. And then finally, rounding it out, what would we be doing if Nvidia weren't higher, Matt? Up 3.4%. And that one's a big weighting to the indexes, so it's almost surprising to see the S&P 500 and the NASDAQ not up more. But this company, along with AMD and others, talked about the future of AI at the Compute Tech's conference. Apparently, investors like what they heard.
Yeah, absolutely. I mean, a gain there, Abby, 3.33% right now, but still not at the all-time high that we saw last week. So 1148 is the level that we hit as an all-time high, and we have kind of come off, Abigail, the highs that we had of 2 weeks ago, right? Week over week, we were down.
Well, it's interesting, Matt, because that is a bit of a bearish divergence to think about for sure. Yes, last week we were down after some very, very big gains. I would also point out that when you have these meme stocks trading significantly higher, GameStop, of course, last week or the week before did raise $1 billion. So something fundamental happening there. But does it deserve to be up 75%? That exuberance. So when you have that exuberance to the upside on some of these stocks where it's debatable whether or not it's justified, and you have the major indexes not quite able to take out their last highs, including Nvidia, including the chip index, it begs the question of what's next. I think everybody's waiting to hear from the Fed in June this month.
Absolutely. Abigail, thanks very much. Abigail Doolittle looking at our early movers for you. Joining us now is Stuart Kaiser, Citi's head of U.S. equity trading strategy. And Stuart, what's your take on, first off, the broader markets after we hit, I think, at least 24 new all-time highs so far this year, and we've just gotten to June. How does this rally look to you?
Hey, Matt, good to see you again. Things look pretty good, I would say, but the risk reward doesn't kind of feel as good as it did maybe a month or so ago. So, our baseline is still for the market to grind higher. We do think, strong underlying growth and strong EPS growth set a pretty high floor. But, risk reward has been a little tricky. Last week, particularly, you had small cap outperform tech, you had value outperform growth. Some key momentum trades like copper, were down significantly. So it does seem like there was a little bit of position churning, going on under the surface. And then getting back to what Mike said, I think payrolls on Friday is an extremely important event. Consensus is at 190K, but our economists are at 140. And if you printed 140 on the back of last month's 175, I think that would definitely get markets' attention and get people worried about kind of a slowing in the underlying trend of growth. So we're still constructive, but, definitely risk reward doesn't feel as clean to us. And that payroll print out Friday is going to be particularly important.
We did have another GDP reading last week for Q1 that was, again, lower than, I think it was 1.6% the first reading, and then 1.4% the most recent reading. How do you see the growth picture? We talk about inflation ad nauseum, but we do seem to see growth slowing down.
Yeah, and you know, from our perspective, growth is actually the much bigger risk to equity markets at this point. You know, our view is kind of inflation to the upside maybe gets you 3 to 5% type pullback in the S&P. But if you were printing low or negative jobs, for instance, you know, that is what can get you that sort of double-digit pullback. So, you know, I would agree with you. Inflation has kind of been the headline discussion, but really growth to us is the key risk indicator. You know, certainly the downward revision to Q1 GDP isn't great. You know, the data last week showing a bit of a pullback in consumer spending, also not great. But, you know, as long as claims stay, you know, down near 200K and we're generating 175 to 200K of jobs on payrolls, then we should be okay. But, you know, to your point, there are some, I guess what you might call cracks forming underneath the surface, and they definitely have our attention, and that's why, I kind of mentioned that risk reward just doesn't feel as healthy as it did, you know, maybe a month or two ago.
Well, I talked about with Mike the problems the consumer is looking at. We saw spending drop, real spending drop last week. We've seen debt continue to rise. He says, you know, debt to income is more important to watch, and granted, that's still much better than it was at the time of the great financial crisis. But interest rates are rising. So this extra debt consumers are piling on is costing more and more. How worried are you about the U.S. consumer?
Yeah, look, I think it's similar to the employment data, where if you look hard enough, you're going to find some data that you don't like. But, you know, sort of the headline stuff seems to be holding in pretty well. So, I mean, the amount of concern that, you know, we've gotten flagged about consumer credit card debt over the last 12 to 18 months, I mean, we probably have a stack of paper, you know, 12 inches high in terms of stuff we've been sent. So definitely it's on people's radar. It feels like just kind of a slow-moving car crash to some degree, and the market seems okay with that. I think it's kind of like commercial real estate as well, right? You get a lot of negative headlines on it, but they just sort of seem to drip out, and the market seems kind of comfortable with that. That's why, from our perspective, yes, we respect all of those things. We do think it's impacting risk reward, but I think until you see headline labor market indicators really start to show weakness, the equity market's going to kind of be able to hold in. So that's why I've just kind of redirected back to Friday. I think that's just an incredibly important data point for that reason.
All right, so your colleague, Scott Cronert, has, I think, a 5,100 target on the S&P. Obviously, we're well above that right now at 52 and change. How do you advise clients right now? I mean, do you hold here? Do you take some profits? What's the move with stocks?
Yeah, I mean, from our perspective, you remain long equity risk until that labor market comes under pressure. You know, I think Scott's bull case would be, you know, well above 5,100, and I think you have to think about what those bull and bear cases would look like, right? I mean, if you get a soft landing economy and the Fed gets a couple insurance cuts off, then you're going to be significantly higher, right? If the Fed is forced to cut because growth is weakening, then you're going to kind of be significantly lower, and that's sort of the, you know, those are the two barbells. From our view, what determines that you're going into that negative outcome is the labor market. So tactically speaking, we're still telling people to run long equity risk, you know, whether that's through call options or through outright cash exposure, but to kind of, you know, keep your finger on the trigger. And if you do see weakness in that labor market, you need to pull back fast. We don't think lower yields are necessary for a rally. And then, frankly, if the Fed is forced to cut, we think that's much more negative for equities tactically, even if it might be positive, you know, 6 to 12 months out. So yeah, we still like owning equity risk. You know, jobs report jobs, labor market, consumer spending. Those are the key kind of risks to be monitoring. And, you know, if you get a couple insurance cuts, then you just, you know, put that in your pocket and enjoy it.
What are the sectors that you like? If you still want to put money to work in equities, where do you do it?
Yeah, it's been a tricky one just because you've had so much rotation kind of under the surface recently. We've generally been positive towards healthcare. That hasn't worked particularly well, to be fair. You know, having some long tech exposure in your portfolio, I think, is just a must at this point.
If you don't have tech exposure already, Stuart, you haven't really been paying attention, right?
I think that's very true. And look, I mean, that's the reason U.S. equities, I think, have been so popular globally. It's one of the few markets where you have large cap tech and growth stocks. So you have to have some tech in the book. We do like owning some healthcare alongside of that. You know, one of the things we've highlighted recently is REITs. Not that we necessarily like them that much, but they seem to be a very, very deep consensus short. And last week, when you had that positioning moving around, REITs were up about 1.8%. So, you know, as a tactical call, if you get a positioning, you know, kind of unwind, I think REITs is something to keep your eye on as well.
In terms of, you know, we talk about the consumer all the time, but I've seen slides out of Apollo from Torsten Slok pointing to, you know, the rising earnings that we've seen for the last 3 quarters in a row are a great leading indicator for business spending. What do you think about CapEx, and can that move the needle?
Yeah, I mean, I think it can, and I think, like the Inflation Reduction Act in particular, you're just starting to see those revenues kind of now, hit the industrial sector. So I think there is an argument that, CapEx and AI is obviously going to be very big. CapEx on the build out of chip production in the U.S., very big. IRA, that revenue is just hitting it now. So, there is an argument to be made that you are going to see some CapEx go through U.S. stocks. I think the question is, if you do see that CapEx spend, then you have to assume that, U.S. corporate is fairly confident in what the growth outlooks look like. If you hear, other bank CEOs and the Fed speaking cautiously, the question is, does that cautious speak from the Fed start to erode kind of, corporate confidence in writing those big checks for CapEx? So, look, I think there are some identifiable sources for good CapEx spend. And, it's really going to be, where the rubber meets the road. Do we actually see those checks get written and those projects get done? But it does look like you do have a tailwind there, particularly in the industrial sector.
All right, Stuart, thanks so much for joining us. Stuart Kaiser there is Citi's head of U.S. equity trading strategy, talking to us on a day when we see a slight rise here in futures. We continue to see that rise mainly on the back of some M&A news. And, of course, there's some big meme stocks gaining today. But AI really rules all, as it has for the last couple of years. Coming up, we're going to talk more about the artificial intelligence race heating up.
Your future laptop, your future PC will become an AI. It'll be constantly helping you, assisting you in the background.
Nvidia and AMD chiefs squaring off at the world's largest computing conference in Taipei. That conversation still ahead. This is Bloomberg.
Your future laptop, your future PC will become an AI. It'll be constantly helping you, assisting you in the background. The PC will also run applications that are enhanced by AI. And your PC will also host applications with digital humans that are AIs.
Digital humans. That was Nvidia's CEO Jensen Huang unveiling the company's latest AI accelerators. He announced Blackwell Ultra chip, which will debut in 2025, and a next-generation platform in development called Rubin in 2026. Meanwhile, AMD announced it will speed up the rollout of its new AI processors. Joining us now with more on the AI race, if you could really call it that, is Bloomberg's Alex Webb out of London. So, Alex, it seems like Jensen Huang has, he's head and shoulders above the competition. Can AMD or anyone else really catch up to him?
I mean, head, shoulders, waist, all the way down to the ankles, yeah. I think. Nvidia's added something like $100 billion in annual spending on the relevant chips, on the accelerators used for AI. AMD, which is the next closest competitor, is expected to do something like $4 billion this year. So it just, say it pales in comparison. It is, doesn't even get close. The thing that is interesting, of course, is that we've just seen Nvidia announce the next generation and the generation beyond that. Meanwhile, you're seeing a bunch of others, not just AMD, but of course some of actually Nvidia's customers, the likes of the big cloud operators, try to get into the space too, but they are trying to get to where Nvidia is now, right? They're moving fast to be able to stand still. Nvidia is already on to the next thing. It gives them a huge head start. And that's not just about the actual technological capabilities, but it's also about the manufacturing capacity, because a lot of these things, or almost all of them, are made under contract by TSMC in Taiwan. If Nvidia, we don't know the details of the contracts they have, but if Nvidia has a lock on that manufacturing capacity for the years ahead, it makes it incredibly difficult for others to get into the space.
Yeah, I love to look at the SPLC screen, Alex, the supply chain screen on the Bloomberg, to see not only who are Nvidia's customers, but who is Nvidia buying stuff from. If there's a gold rush, you want to make the picks, right, and the shovels. And I noticed that memory chips are becoming kind of a bottleneck. You need, obviously, a lot of memory to run large language models. Are there other opportunities that maybe investors are digging up around Nvidia?
Well, the memory chips thing is particularly pertinent. We've seen the likes of SK Hynix really play well in this space. It's about the next generation of memory chips that are able to respond with far greater or far lower latency, far greater speeds to the demands of the AI accelerators. Now, it looks as though SK Hynix is very well positioned at the moment. There are some others who might also manage to get into the space. Of course, going way back in the supply chain, we have, of course, ASML, which is, essentially got a monopoly on the equipment used to make the next generation of chips. They sell those in turn to TSMC, which then sells them to Nvidia. So I think investors are starting to become savvier about this supply chain. There are a few others in the space offering discrete parts of semiconductors, but it seems as though the small number of real beneficiaries are pretty well telegraphed at this stage.
I love that ASML has like a button, and whoever's in charge of that, whoever controls the button, can turn off AI chip production for the world. So I thought that was pretty interesting. What else are we looking at in terms of like valuations, Alex? I was thinking at the beginning of last year are getting pretty frothy, but this stock, Nvidia at least, continues to run higher and higher. And everyone I talk to, investors, tell me that valuations really aren't that high.
Yeah, I mean, look, the absolute number in terms of the market capitalization, I think it's nudging north of close to 2.6 trillion at this stage. But when you look at it as a multiple of its forward earnings, they aren't necessarily crazy numbers. Sure, it's at a premium to the market. I think it's trading at about 37 times its 12-month blended forward earnings. Now, that isn't a crazy number when you look at some of what other tech companies have done in the past.
Alex, great to have you on the program. Thanks so much for joining us. Bloomberg's Alex Webb talking to us about Nvidia on the rise again today. Coming up, the morning calls, and then later the global airline industry is set to rake in nearly $31 billion in net income this year. We'll talk to Helane Becker of TD Cowen. This is Bloomberg. Time now for our morning calls. First up, JP Morgan downgrading Kava to a neutral, citing lofty valuation levels and saying that it prefers Chipotle over Kava. Next up, Citi double upgrading Best Buy from a sell past a hold to a buy. The analyst sees upside thanks to tech replacement cycles and says AI innovation will increase consumer demand. And then finally, Citi Securities is cutting its rating on Dell Technologies to a hold. The PC maker fell short of expectations for its AI server business when it reported earnings last week. Coming up, we're going to talk to Tony DeSpirito from BlackRock. This is Bloomberg. This is the countdown to the open. You're listening to some natural sound of the people at Skechers and Cord Energy getting ready to ring the bell. We're moments away from the start of trading. Futures are rising, not across the board. I think Dow futures are unchanged or maybe even a little bit in the red. But who looks at the Dow? We've got the Russell, the NASDAQ, and S&P futures here all up, with the small caps gaining the most, up almost 1% on the Russell 2000. In terms of the other asset classes that we watch, important obviously to always keep an eye on what's going on with the euro at 108.51, the 10-year yield at 446, 447, and NYMEX crude oil, especially today, we should be watching after the OPEC Plus agreement over the weekend. Right now down 1% at 76.18. One of the stocks that we want to watch at the open, well, you might want to, you might not care, GameStop, surging again after Keith Gill, or Roaring Kitty, posted on Reddit showing what appears to be a $116 million bet on the brick-and-mortar video game retailer. Abigail Doolittle has more on GameStop. Abby?
There are so many directions we could go here, Matt. One of them being, have you played Uno and used that reverse card? Because the signal there is the idea that we're going to see a reverse in direction. Now, out of the April lows to the recent highs, the stock had been up more than 500%. Then out of that high into the recent lows, so much volatility here for GameStop. This stock had been down about 72%. Today, it is up 64%, although off of its pre-market or overnight highs when it it had been more than a double. And this, of course, on that news that Keith Gill, who is one of the sparks for the 2021 meme rally, has a position of $116 million, an additional position, I should say, because I think that back in April, he had a pretty sizable position. In addition to buying a fair amount of calls, I did speak to Steve Sosnick at Interactive Brokers, who said that that call in question, that there is a large open interest, so it's very possible. Because, of course, that screenshot that was on Reddit that he made of these positions, we're not able to verify it, but it certainly has created the confidence that we have this stock higher. It's not just GameStop, it's also AMC, Virgin Galactic, and some of these other meme stocks. In fact, SunPower higher, and they put out news not so long ago that they are issuing warrants to buy up to $33.4 million. So this meme rally, not only does it have real consequences to the upside and downside for investors, but these companies changing their capital structure, it's really pretty interesting to see this trend continue. Yeah, such a huge jump that it looks like there's a halt on trading right now in GameStop shares. But $38 was the last trade, and the open was for more than 40. And of course, this is really a $10 stock a couple of months ago. Abigail, thanks very much. We'll continue, obviously, to watch that. But we're also going to focus in on the big heavy hitters, and those are the chip makers. Nvidia and AMD rising after the CEOs of both companies made big AI announcements in Taiwan, or at least used a lot of hyperbole in talking about the future of AI. Alex Webb is back with more. So what did they give us that's substantive, Alex?
The thing that's really fascinating when you look at the way their strategy is developing is this whole first wave of AI investment really came out of the big cloud operators, the likes of Google Cloud, Amazon Web Services, and Microsoft Azure. What we're seeing now is essentially trying to eat more further forward into the value chain by getting more onto people's laptops. That will create demand in and of itself, but crucially, it's an on-ramp to that cloud demand. So it's fascinating from a corporate strategy perspective, the way they're essentially building out the demand for their products.
You know, we've seen the hardware makers. I mean, Dell is down today because of a disappointment and was down a lot the last couple of sessions because of a disappointment with earnings. But Best Buy is a big gainer, Alex, because I guess investors are betting they're going to be AI devices that we're all going to want to rush in and buy, or at least buy from Best Buy online. It's really been a hardware success story, hasn't it?
Yeah, there is, in the sort of tech hardware space, mounting optimism about a refresh cycle. When we think about smartphones, people willing to get the latest iPhone, well, they've gone from refreshing every 2 years to every 3 years, and sometimes even a bit longer than that, because fundamentally there aren't that many hardware upgrades that we've seen for much of the past 5, 6, 8 years in smartphones. As we see AI capabilities from a software perspective built into smartphones, there's going to be a need for the AI hardware to support it, and that's driving a huge amount of optimism.
On that note, I mean, I imagine you're a consumer of this technology as well, Alex. I'm using ChatGPT all the time, but when I can't, use my fingers on the phone to access it, I try and get Siri to give me the same information, and she seems fairly useless. When's Apple going to catch up?
So June 10th is the big date that a lot of Apple fans are going to be looking at. That's Apple's Worldwide Developers Conference, where they show people who develop software for their devices what they've got in the works, what they're going to be supporting going forward. And the real interest here will be whether there's support for ChatGPT hardwired into Siri, whether GPT 4.0 and others are going to be supporting the way that Siri operates. A lot of bated breath around that, and if it does happen, it will drive, again, a lot of optimism.
All right, Alex, thanks very much. Alex Webb covers tech for us out of London. Let's get right now over to our guest for the hour here, Tony DeSpirito, Global CIO of Fundamental Equities at BlackRock. He lays out his outlook, writing, quote, "The market is historically concentrated, but we expect earnings to broaden out, which should lead to the market rally broadening." And Tony, just in this, I guess, big pocket of AI, we're seeing that, right? Because it's not only Nvidia now that's making the chips, but we're also interested in, Dell that should make computers, and Best Buy where we can go in and buy them. Like, you really do see this broadening out in terms of the consumer spend. Where else do you see it happening?
Yeah, so I think this is a really important point, because the market's been dominated by the Mag 7, but we see that moving as we move throughout the year. We see the market broadening out. You point out, even within AI itself, there's a broadening, right? AI PCs, memory stocks. AI needs to be powered, so we've seen utilities now catch a bid. The data centers need to be cooled, either through water cooling or through HVAC, right? So even within AI, we're seeing the market broaden. But if you look at earnings estimates for the Mag 7 and for the rest of the market, right now there's been a huge gap, Mag 7 winning handedly. As we go through the rest of the year, you start to see that equal out. And by fourth quarter, you see earnings estimates about equal. And we always think about investing as a combination of it's about earnings growth and about valuation. And so as you see the earnings growth broaden out, then look at the valuations. The Mag 7 trades at about 34 times earnings. The rest of the market, the equally weighted index, trades at about 16.5 to 17 times earnings. That's a really big gap, particularly when you see those estimates normalizing as we go forward. I think that's a huge opportunity for active investors.
So for active, I was going to ask if investors should just kind of take Jack Bogle's advice and pile into some index tracking funds, or if now you need to get an active manager or get an active ETF to benefit from this trend.
Yeah, so I think it's really interesting. Conventional wisdom has become, particularly in U.S. large cap space, just index, because there's not a lot, it's such an efficient market. And we've gone back and looked at 20 years of data, and if you look at the top quartile manager in U.S. large cap, that manager has produced on average about 320 basis points of alpha per year. That's nothing to sneeze at. Now, can you produce a greater percentage point alpha in some of the niche areas like EM or small cap? Absolutely. But you got to remember the size of the U.S. market is just so important for U.S. large caps and clients' portfolios. U.S. large caps make up about 63% of the global MSCI ACWI index. If you think about the Russell 2000, which is the basic U.S. small cap index, the market cap of all the companies combined in that index are about the same as the largest single stock U.S. large cap stock, Microsoft. And so I'm not suggesting that I think it's a question not of or, I think it's a question of and. I think there's a lot of opportunity to get alpha through active management, even in U.S. large caps, particularly when you think in terms of alpha dollars, right? The percentage alpha times the amount invested. That's where I think you're really missing out if you're not looking for alpha in U.S. large caps.
Well,
as you point out,
well,
yeah.
I was just going to ask about the ETFs, because I've talked to you before on the ETF program, which, by the way, airs today at noon. You run the BlackRock Large Cap Value ETF, right? And you guys have gone big into active management ETFs. You have dozens of them out there. I know that investors have put a lot of money into those. How have they performed relative to their benchmarks?
Yeah, so I think active ETFs are a really interesting development. It's another way to deliver alpha to clients, another form, another wrapper. And some of the advantages of the wrapper are transparency, intraday liquidity, tax efficiency, et cetera. And we at BlackRock, really tried to marry our world-class ETF franchise with our world-class active franchise. And we've launched 36 funds, active ETFs that now have about 13 billion of AUM. I'm particularly proud of the one that I've launched, the BlackRock Large Cap Value ETF, BLCV. We launched that just over a year ago in May of last year. We produced over 700 basis points of alpha since inception. And so it's something that we're really excited about for sure.
What are the risks that you're worried about, Tony? I mean, we kicked off the show with concerns about the consumer. We saw on Friday real spending has dropped. We've seen, this huge amassing of debt for the consumer with rates that continue to be higher. So, all the new debt that you're racking up is even more expensive than the old debt that you had. Is that one of your chief concerns?
Well, so first of all, the history of the market is about climbing a wall of worry. So there's always something to worry about. And I think, particularly, I think this goes back to the advantage of active. How do you position against those worries? So what am I worried about? Am I worried about valuations? Yes, when you look at the S&P 500 overall, you see valuations are elevated. They're not off the charts, but they're elevated. The market's over 20 times earnings. How do you solve for that? Well, certainly going beyond the Mag 7 is one way to solve for it. Value investing is another way to solve for it. The portfolios I run on average have a PE multiple about 12 to 13 times current earnings. Are you worried about the economy? Sure. Debt is high, so you know what? Focus on companies that have really strong balance sheets, that have high quality earnings, et cetera. And so I think, yes, there are things to worry about, but there are ways to solve for that within an active portfolio, and that's what we're doing here at BlackRock.
All right, Tony, great talking to you. Thanks so much for joining us. Tony DeSpirito there. He's the global CIO of Fundamental Equities over at BlackRock. Coming up, high demand for summer air travel.
Demand for us is steady as she goes. In a way, kind of boring. After the last couple of years, I think boring is good, but it really is not getting a lot stronger, but not getting weaker. It really is pretty steady.
We'll give you the latest on the global airline industry amidst a windfall of profits. Next, this is Bloomberg. Breaking US PMI data crossing the terminal right now. For that, let's go to Bloomberg International Economics and Policy correspondent Mike McKee. Mike, what do we have?
Well, top of the show, we were talking about whether the economy is slowing or not. The S&P PMI suggests manufacturing is certainly not slowing. Comes in at 51.3. That's up from 50.9. And the forecast was also 50.9. No change. But it looks like we have a gain from there. We have seen strength in manufacturing in a couple of different places today, in Spain, in Germany, and in the Eurozone overall. We've seen numbers come in at or better than they had been. But this is the highest one around. So pretty good news. Coming up top of the hour, we will get the ISM Manufacturing Index. It is expected to rise but be below 50. Let's see if it, too, can top that level.
So, all right, this is the S&P Global U.S. Manufacturing PMI. So positive surprise means, is the economy not slowing down?
Well, manufacturing, at least, is not in terms of the responses to the S&P index. Essentially, when you go below 50, you're looking at some contraction. So manufacturing picking up, according to S&P. And we'll get numbers, as I said, at the top of the hour on the ISM. And then Friday, we'll see what manufacturing payrolls look like, see if they have fallen off at all.
All right, we'll be watching closely. Mike, thanks very much. Michael McKee there with your PMI data, 51.3, so better than the survey, which was 50.9, and better than the prior at 50.9 as well. The global airline industry is on track for a strong year. IATA, which is the International Airline Association, expects high demand to fuel over $30 billion in net income. That's up more than 10% from a year ago. Joining us now to discuss is Helane Becker, Senior Research Analyst at TD Cowen. So, Helane, this seems like a very good sign for airlines. What's gone right for them this year?
Yeah, it's a good summer. And a lot of what's going right is people still want to travel and they still have the means to travel. It's slowed a little bit from the 22, 23, I guess, hysteria we saw in terms of people trying to get out and we're tired of being cooped up. So I think we've reverted to a more normalized growth rate. But still, when you think about the size of the world's economy, not just the U.S. economy, but the world's economy, which is what IATA looks at, what we're seeing is very strong demand worldwide, and the size of economies has grown in the past 5 years. So you would expect natural growth to occur, and that's what we're seeing.
Are these airlines globally capacity constrained? Because I notice here in the U.S. at least, every time I check in, I'm asked, how much I'd be willing to take to give up my seat. And indeed, over Memorial Day weekend, there were a lot of flights canceled because they were just overbooked.
Yeah, well, canceled and delayed because of weather also. That happens a lot too, especially in the summer months. The winter's a little bit easier because snow storms are a little more predictable than pop-up thunderstorms. But I think the way to think about the capacity issues are there are delivery delays from the OEMs, so airlines aren't getting as many aircraft as they thought they would. But the impact is really on aircraft retirements. Airlines aren't retiring aircraft as rapidly as they have in the past. And then the other issue with the Pratt & Whitney GTF engine issues, those issues are not going away anytime soon, although as we go further into the decade and Pratt gets more experience in repairing them and more facilities open to repair the engine issues, you'll see that abate as well. But pragmatically right now, we just have a limit on how much airlines can grow because they can't get new aircraft. They're keeping older aircraft in service longer, which means they go into the maintenance bays a little bit more often. And although the airlines try really hard to get all that maintenance out of the way before we head into June, July, and August, things happen. You know, it's sort of like with your car, things happen and you have to handle it when it happens. But I think in general, we're okay. We have enough pilots, and the IATA forecast you referenced, remember, they're a worldwide organization. So they're looking at Asia, South America, North America, Europe. And so for that forecast, and I guess Asia, if I didn't mention that, so that forecast just encompasses a really good environment. When you think about the way things recovered in the last 4 years, you saw, North America kind of recover first, then Europe, Asia's recovering this year. So you see the demand kind of move around the world that way.
Helane, we just saw the year-to-date performance of these airlines, and there's a massive divergence, right? Delta is up 40% year-to-date. American Airlines is down 20% year-to-date. What is Delta doing right that AAL is getting wrong?
Yeah, so American has had a really tough time of it recently. And a lot of it just has to do with the way they're growing coming out of the pandemic. So if you look at United and Delta specifically, United and Delta just grew differently. They didn't retire as many aircraft. United especially didn't retire any of its wide-body aircraft, and Delta kind of used the opportunity to clean up. But American retired almost all their older wide-bodies, and it was a good guy, bad guy event. On the positive side, they were able to narrow the fleet types down to 5 from 9. But on the negative side, as international has grown faster than domestic in the last year and a half, they're not participating in that. So that's one thing. The other thing is United and Delta especially, have both renegotiated their credit card loyalty agreements, their co-brand credit card agreements. And Delta said in their last annual report that that contributed $6.8 billion to revenue, and that is on its way by the end of the decade to $10 billion. We think United, which hasn't disclosed it, is somewhere in the vicinity of that, maybe a little bit less. But we know American is well below that because they haven't renegotiated their contract in more than 5 years. So they're in that process now. That should catch up. And that's probably a second half 24-25 catalyst for the shares. But pragmatically, they've just handled things so differently, and especially on corporate, where they just forgot that corporate would recover as people started to go back to the office. And I say 4 is the new 3, and people over the next few years will be required to be back in the office 5 days a week. It's just the way things are going.
Yeah.
And as that happens, people will travel more, and American kind of forgot that. So they've got a little bit of rebuilding to do.
All right, Helane, thanks so much for joining us. Helane Becker there. She's Senior Research Analyst over at TD Cowen, talking to us about the airlines. Now for some of the other sector price action this morning, let's get over to Bloomberg's Abigail Doolittle. Abby?
Well, we do have the S&P 500 up about 0.3% right now, Matt. So sector-wise, we're looking at more sectors higher than not, led by tech and healthcare. Tech, of course, having to do with some of that chip action you were talking about before. Healthcare on some of the summit news, along with other news. Energy down 1.3%, in line with oil. Very quickly, Matt, you were talking about the Dow. I think it went above 40,000 very quickly. I don't even think it closed above that level. But since going above 40,000, take a look at the divergence between the Dow and the Dow Transports and the NASDAQ 100. It's unclear which of these indexes is, quote unquote, correct, but certainly worth taking a look at.
Yeah, really interesting split there. Abigail, thanks so much. Coming up, the market-moving events you need to be watching today. That's in our trading diary next. This is Bloomberg. Time now for our trading diary. The ISM manufacturing data coming out in just a couple of minutes' time. And tomorrow we're going to get the U.S. JOLTS numbers. Mike was telling us about that. Wednesday, the ISM services data. And Thursday, an ECB decision to watch. Finally, on Friday, of course, the U.S. payrolls, non-farm payrolls data coming out. This is Bloomberg.